Welcome to this video. This video is especially for our FAC3702 students. Please note that this question is in your tutorial letter 102. The purpose of this video is to indicate to you when you read through a scenario what to identify as important information, and when you read through the scenario, I want you to identify the applicable learning unit that you need to apply to that paragraph. Then when you read through your requirement, important, I'm going to indicate to you a bit of exam technique principles, and then when we look at the solution, also exam technique, but how to link your knowledge when you attempt the question. It is crucial, please make notes when you look at this video, because this will be your questions. If you have questions, we will address them. I want you to post them and we will talk about them in our Teams meeting. Right, now let's first read through the scenario. Normally when I read through a scenario, number one, I make use of a highlighter, but this is not a coloring in competition. There's a lot of information, but please do not highlight every single word. ChocoCoffee Ltd is a company situated in the north coast of KwaZulu-Natal. The company has a 31 December year end. The following details are available regarding certain assets immediately. We know we need to look at our assets learning units of the company. We have a roasting machine. When we identify that this is a machine, most probably PPE. On 1 November 2010, ChocoCoffee Ltd placed an order for a coffee bean roasting machine from an Italian company for £3,000. The invoice amount is payable on 30 June 2011. The order was shipped free on board on 1 December 2010, and the machine was available for use as intended by management on 1 January 2011. Now let's just stop right there. First, we need to identify that this is a foreign currency. Therefore, we need to follow IS 21, which you know is our foreign exchange gains and losses learning unit. So this is Forex, right? And then we are able to identify the invoice amount is payable on 30 June 20.11. Therefore, if it is payable, we know that we will have to recognize a creditor, which will be outstanding at year end. The order was shipped free on board on 1 December 20.10. Therefore, when will ownership transfer? On 1 December 2010, and the machine was available for use as intended by management on 1 January. Now, why is this important to us? Because IS 16, our PPE standard, indicate to us that we need to start with the depreciation once the machine is available for use as intended by management. Sorry guys, apologies. As you can hear, my voice, I am a bit sick. So just please bear with me if I need to take a few breaths in between. The machine was brought into use on 1 January 20.11. 1 January 20.11. Therefore, again, guys, we need to start with our depreciation. Then, the useful life of the machine was estimated to be 10 years with a residual value of 5,000 Rand. The residual value and the remaining useful life of the machine remained unchanged. This is important because we need to make use of our 10 years in terms of our depreciation, and we need to take into account our residual value. How do we take this into account? We need to use the cost minus the residual value times our useful life of the machine to be able to calculate our depreciation. Then the following dates and exchange rates are applicable. Why is this important? Because we need to identify at which rate we will have to account for our asset which we've identified is our roasting machine and our creditor. Remember, if you think about your basic journal entry in terms of roasting machine and creditor, we will have to debit our property, plant and equipment, which will be our machine with an amount, and credit our creditor with an amount. Right, therefore the rates will be important to us. Very important rate, as always, will be your year-end rate, which will be 31 December 2010, 31 December 2010, and we have a payment date, which is 30 June 2011. Remember, 30 June 2011. Next paragraph, processing plant. Again, immediately we identify it's a plant. We need to look at our PPE. ChocoCoffee Ltd owns a processing plant used for the roasting, grinding and packaging of the coffee beans. The property was purchased on 30 September 2010 for 3 million. Land, 1 million. Building, 2 million. The property was available for use as intended by management on acquisition date and was also brought into use on this date. Right, now when we look at the first sentence, immediately we need to identify that land will not be depreciated. But building, we need to identify that this will be depreciated normally based on our straight line method. Remember, you do have the production method as well, but most probably straight line method. Then the property was available for use as intended by management on acquisition date. When is acquisition date? Acquisition date will be 30 September 2010. Therefore, we know we will have to start with our depreciation on 30 September 2010. Then, a residual value of 500,000 was allocated to the building. The useful life of the building was estimated to be 25 years. Again, what is important here? We need to determine our depreciation, which will be the cost minus the residual value divided by the useful life in years. Next sentence. On 31 December 20.11, look at this, guys. 31 December 20.11, an independent sworn appraiser determined the fair value of the land to be 1,250,000. Therefore, immediately when we look at this, we are able to identify most probably our land will be accounted for based on our revaluation model. And I want you to write this down. This is rules that you need to know. And I actually forgot to mention this at the top. Accounting will be a bunch of rules that you need to know and study. Please, guys. Right. Rules prescribed by IFRS. Immediately when you identify that the land is based on our revaluation model, you need to think about your tax, which will be based on our CGT rate. This is a rule in terms of IAS 12, paragraph 51, and I think it's C. Right, the third asset, office block. ChocoCoffee Ltd owns an office block which is leased out. Look at this, it's leased out. Therefore, immediately investment property, it's leased out. You should be able to know the differences, and I am going to refer you to another video as well. For their administrative purposes, the property was purchased on 1 March 20.11 for 1.6 million. The land is 600,000 and the building 1 million. Immediately, what you need to be able to identify at initial recognition is what is our accounting policy. Remember, investment property can either be based on our cost model, and then we will follow our PPE rules, or this can be based on our fair value model, and then we need to follow our investment property rules. They indicate to us the fair value of the property on 31 December 20.11 was determined to be 2,050,000, land 700,000, and a building 1.3 million. Right. Accounting policies. The following is an extract from the accounting policies of ChocoCoffee Ltd. Owner-occupied land, look at this, is accounted for using the revaluation model. It is the policy of the company to realize any revaluation surplus upon disposal of the underlying asset. It is company policy that revaluations will be made with sufficient regularity to ensure that the carrying amounts do not differ materially from those which would be determined using fair values at the end of the reporting period. Then owner-occupied buildings and machinery are accounted for using the cost model. Investment property is accounted for using the fair value model. The carrying amount of the investment property will be recovered through sale. Important. Now, what does this mean? And again, guys, I want you to please write this down. In terms of IAS 12, it indicates to us that our fair value adjustment, the manner of recovery, how are we going to recover the value of this property? It will be through sale. We will sell the property. Therefore, our tax will be based on our CGT rate. Extremely important. Accounting policies continue. Depreciation on buildings and machinery is provided for according to the straight line method over the estimated useful lives of the asset. The South African normal tax rate is 28% and capital gains tax inclusion rate is 80%. The South African Revenue Service allows the following capital allowances. Why is this important? Because we need to calculate our tax base. An annual allowance of 5% on the processing plant according to section 13(1) of the Income Tax Act on the straight line method. Look at this, not proportionate for a part of the year. This is important. I'm going to explain this to you just now. Next bullet point, a tax allowance on machinery in terms of section 11(e) of the Income Tax Act on the straight line method over 6 years. Look at this, proportioned for part of the year. And then there is no capital allowance granted on the administrative buildings. Remember, this is our investment property buildings. Now, what does this mean? Not proportioned or proportioned for part of the year. If you take this one step back and we include a timeline, let's say that this is our year 1. This will be the 1st of January and this will be 31 December. If it is proportioned for part of the year, let's say we purchase our building 1 July. We will have to determine the depreciation for this building for 6 months. Therefore, this we will proportion it over 6 months. If it is not proportionate in terms of our tax allowance, we will calculate the tax allowance for the full 12 months, 1 year. Okay. Next paragraph. Deferred tax is provided for on all temporary differences using the statement of financial position approach. The company will have sufficient, let's just read the first sentence, Statement of financial position approach. This is what we teach you. This is where we make use of the method. We determine our carrying amount of our assets and liabilities. We determine the tax base, temporary difference, and our deferred tax at the end. This is your statement of financial position approach. We make use of our assets to determine our deferred tax. Next sentence, the company will have sufficient taxable profit in future against which any unused tax losses can be utilized. Now, there's no unused tax losses in this scenario. There are no other items causing temporary or exempt differences except those identified in the question. Now, the reason why they provide you with this sentence here is, should there be a deferred tax asset, we may recognize this because there will be future economic benefits to be able to use that asset. And you will understand this if you watch the YouTube video that I have provided you with in the Teams meeting, as well as my UNISA, in terms of a revision of IS 12. Now, if you're not sure, guys, this is not the ad, let's just skip the ads. This is the video. Please ensure that you do watch this. I do cover the important principles on this video that I want you to be able to know and understand.